There we go. Okay. Let me just present. All right. Pretty self-explanatory. But the first slide we're looking for is just the company and your name.
Hello. Hello, everyone. My name is JP Fairchild,
I'm Mickey McLaughlin.
and today we're going to be doing our stock pitch presentation on ASML and why we think it's a good buy for the club.
First thing that every pitch needs is kind of this overall thesis slide. Really just a brief description about the company, how many shares you want to add, kind of like the 1 point summary, like why, and then also some more details surrounding, their current share price. One new addition that I should point out here is the stop loss. This is the way around that ETF, automatic split policy I mentioned last meeting. By pitching your stock with a stop loss, there's, which I don't want to spoil, we can effectively just leave that on the trade. And this way we don't have to have our actual stock holdings after each year.
Okay, so just a quick description of the company. Real quick, how many of you guys, just a raise of hands, have heard of ASML? All right, so about half. Basically, ASML is a Dutch company that plays a vital role in the semiconductor chip manufacturing process. They're responsible for providing manufacturing equipment such as their advanced lithography systems, which create tiny patterns on silicone wafers. And we are proposing to buy 13 shares at a trade price of $680, total value of $8,850. And kind of the reason why, well, we see a potential 72% upside. Oh yeah, with the stop loss of 20%. And so real quick, for those of you who don't know ASML, this is an example of what they manufacture. This is their advanced EUV system, lithography machine used in making these chips. And so just at a quick glance, we can see that this is a very complex machine. There's a lot going on here, and this kind of reinforces their dominance. It would require a lot for a company to try and replicate what ASML has. I'm currently reading a book right now about ASML. It's called Focus, which I think is kind of ironic because I can't make anything out of this picture right here. But basically, they describe in the book that it takes 7 Boeing 747s just to deliver one of these machines to their customers. And I think that's kind of insane. And it kind of points to their market position, which they're currently at around 90% market share when it comes to the manufacturing equipment supplied to these manufacturers in the whole semiconductor industry.
So we're kind of jumping around here. This is not where this is supposed to go. But to build off that, there's a lot of interesting things when it comes to comparables. There is no comparable to ASML. FactSet says there is, but ironically enough, if you look on this second one here, where the company names are, ASML International is one of their subsidiaries. So literally they're competing with themselves is what they're saying. Barron's kind of backs us up when they called it a near monopoly on their most advanced chip making machinery this morning after their earnings report. So this is kind of what FactSet comes up with. If you look at it, they're pretty much at or above average for everything with who they say they're competing with. But like BE Semiconductors, like a TSM, which we own. So there isn't really much comparables to do here. That's why we're kind of just breezing over it and mentioning it's pretty much a monopoly. So there is a different comparables model, which I know Max will get into, but we kind of just put this up here and are going to go with that. There aren't many comparable companies, if any.
Yeah. And
Right.
to kind of reinforce that, I mean, sometimes there's some valuation methods that aren't as applicable for companies. And that's why, comps in this case really isn't for ASML. But moving on, for the company umbrella or entity structure, this is important because it can help really display what the company owns as its subsidiaries, kind of what's the structure of it, does it operate in maybe some, politically unstable regions, and so it's a good way to kind of gain a picture of some larger companies that are more conglomerates. The example here is like Procter and Gamble. I think it's a pretty old example because they spun off a lot of these into like separate companies, but still an example nonetheless. And so I'll let you take it away.
Sure. So this is their company structure. It's really just subsidiaries. It's nothing else other than that. They operate in a lot of places: United States, South Korea, Netherlands, Taiwan, Germany. The only one of concern here would be Taiwan and possibly tariffs. But other than that, nothing of crazy concern for them. The Netherlands is their main operation. They don't operate. So a lot of the numbers like later will be in euros, so don't be shocked.
Yeah, I mean, this slide is pretty self-explanatory, but this is just their current stock price. Ideally, you put like a year or, at least sometimes you can see how historically it's performed. I also added in this new part where you put the 52-week high and low. It's just another way to kind of see how volatile and how it trades. And so, the example for this, again, Procter and Gamble at the time of this, which was probably a long time ago, traded their 52-week range was 121 to 147. That's pretty much it there. One thing to note with this is ideally do this the night before your pitch when the market is closed, because during the trading day, like if they put it up now, it would change every few minutes as the stock market fluctuates. So just something to keep in mind.
Yep. Here's JP and I not listening. We did a 1 day instead of a 1 year. But there's the 52-week range to 1100-ish, give or take. And then the low part's 645. They're trading somewhere closer to 700 today after earnings. They had a good earnings. So this is a little bit behind the 8 ball, but our projection kind of comes right towards the top of that 52-week range, which is important because they have seen some of those downturns, but they will see upturns as this AI thing kind of gets rolling, especially with Stargate and everything here in the United States, which involves a lot of the companies they supply to.
Oh, yeah. Just really touching on the management and C-suite can be pretty important for a company to kind of see like what's their experience, what's their track record within the industry, and you can put what school they go to. But at the end of the day, I think it's really most important to understand, how have they done in the past? For example, if this was Starbucks pitch, you could point to Brian Nichols, he's their turnaround CEO. He looks great, on paper, like would be the best possible candidate. And so I could point to like a strong management team, which they actually pitched Starbucks a couple months ago. So this is their second pitch, but I'll let you guys go.
Okay, management. Three big ones. The CEO, Christoph Fouquet, I think is how you say it. He's been with the firm for 17 years and 1 month, so pretty long time. Current title of CEO and president. They merged into one for 10 months. Prior to his time at ASML, he was the director of marketing at KLA for 5 years. When he arrived at ASML, he started in the marketing department, so he's seen that climb through just like the corporate ladder there, even through the C-suite ladder. And then CFO Roger Dawson has been with ASML since 2018. And according to their website, his term is expected to end in 2026. I don't exactly know what that means. I guess they put him on term basis for some of these other C-suite things. Rich history in accounting, spent 30 years at Deloitte, and he was the firm's CEO for a couple years. I'll go with this guy's first name, Frederick. I don't know. There's not much on him. They just says that he joined in 2009. And then he was appointed to the board of management in 2010, and his term also expires in 2026. Pretty boring LinkedIn page. He has one connection and like has nothing on there. So it's about all I can give you on him. And those are just pictures of him.
Yeah, moving on to more of the empirical numbers, really just the hard numbers behind the company. This is a bit of an older slide, so you'll see they'll have more. I added in some more empirical numbers to really paint a bigger picture. But a lot of these numbers can help us kind of understand how's the company done, recently, how have they done over time. And really, I mean, the goal of this is to kind of just point out if anything kind of is a red flag or if anything looks good, point to the strengths and weaknesses within the numbers. But do not fixate, I'd say, too hard on this slide.
Okay, on that. Market cap 286 million. Last 12 months revenue 28,000-ish. LTM EBITDA is around 9,000. There's 393 million shares outstanding. Diluted EPS is 21.50. Beta's 1.5, 1.6 if you want to round up. And then their WACC is 7.9, which you'll see later in the DCF. Quick ratio 7.3. These are all in US dollars, by the way. These are not in euros. Quick ratio 7.3. Dividend yield 8.3. Nothing crazy. The PE, the trailing, which I think is what Max wanted, is 37.46. The 27.7 is the last 12 months or the next 12 months. That's the next 12 months PE. Probably should be higher based on the way we value it and what we see. But yeah, nothing that stands out crazy here.
Moving on to sustainability, as a club, we do have a requirement that we pitch stocks that are double B and above. So, I mean, you can see kind of on here, but any stock you pitch has to be double B or above. They obviously work, but I'll let them get to that. And that is one of the prerequisites. It's just really one of the things that, ensures we're investing in ethically compliant companies. I don't know. And the other, rule surrounding this is no sin or vice stocks, which really you can use your best judgment for, but in non-inclusive lists is like consumer weapons, drugs, alcohol, stuff of that, adult entertainment, stuff of that nature. But go ahead.
Yep. So shockingly enough, they're actually a triple A, which is the top of the chain. They're number one of 374 in semiconductors for the industry group for their overall ESG rating, which is very good. The only thing that's not great, I guess, is their satisfactory and overall ESG rating and their temperature rise. I have no idea what that means, so don't ask. They're at 2.9 degrees Celsius and they're misaligned with the industry. I mean, I don't know if you can get much better when you're building machines that make chips, so not exactly sure what to really say about that. But everything else looks good and it meets the criteria. So
moving on to really the company factors. Again, this is a bit of an older slide, but the idea still works there. You want to talk here on the bull, which is the good things, and the bear, which is the not as great things that you see with the company. And so this really paints a picture from both sides as to what are some benefits to investing in the company, but what are also some risks? Because we have to consider the company from both angles, right? We don't just want to fully kind of launch in favor of it and ignore some risks and then absolutely have the pitch fail. So just something to keep in mind. You can look up SWOT analysis or, use other resources to help find these factors. But this is a very crucial part as it kind of demonstrates your research and knowledge of the company. Well, if you guys go ahead.
Okay, so starting us off with the first, I'm going to start with the bull factors. The first one being massive AI infrastructure investments. Mickey just pointed out earlier the whole Stargate thing. I think they pledge on spending upwards of $500 billion on the total project. And this just kind of shows you the demand for these chips and most importantly for the manufacturing equipment that comes with making these chips. So that's a huge tailwind for a company like ASML. And then second, I want to talk about reoccurring revenue through long-term service contracts. I failed to mention earlier, but those machines that I put up earlier actually cost upwards of $400 million. So ASML not only reaps the benefit of those insane prices, but they also engage with long-term contracts for servicing these equipment, such as maintenance and repairs. Companies are spending a lot of money making sure that companies are spending a lot of money on these equipment, so it's very vital for them to make sure that they're used as efficiently as possible. So this kind of provides some stability in the cyclical industries, such as the semiconductor industry. And then going on to the third one, monopoly and supply chain for patterning process. I did mention earlier that they control about 90% of the market share when it comes to this manufacturing equipment. But what I forgot to say is that, a potential benefit is price increasing and price power that this company can take advantage of. And this is just, another factor that needs to be considered for when you're projecting the future revenue of this company. And then lastly, we have the backlog of orders. These machines are super complex. They take upwards of 8 to 12 months to build. And so a lot of companies like TSM, Samsung, Intel, the major customer base for ASML, place a lot of orders ahead of time to try and meet this demand. So this shouldn't be seen as something that's negative. It should be seen as something that's carrying forward the demand, where you can actually also see some sort of predictability when it comes to the revenue of this company. I've looked at their latest earnings report, and not only do they project for the upcoming year, but they also go as crazy as the next 5 years or the next 10 years, if you look at some of their presentations, which I think is something to consider as an investor. All right, now for going on to the bear factors, the first one, the most obvious one is their largest customer is TSMC, Taiwan Semiconductor Manufacturing Company. This poses some risks when it comes to make mainly the fact that a lot of ASML's revenue is dependent on the capital expenditures of TSMC and Samsung and Intel and those companies. And then going on to the second one, we have potentially unfavorable product mix. I didn't get the chance to really dive into this latest earnings report, but I looked at the Q3 report and they said that, be wary of gross margin because of unfavorable product mix. And what this means is they basically make two different types of machines. One, deep UV machines, which are for making chips that go into like remotes for TV, something of low processing power. And this comes with a little bit lower margins. And then you have your advanced UV systems, which are made for processing certain capabilities like AI, stuff that's stored in databases. So depending on the demand you have for certain chips in a given quarter, you might see some fluctuations in the gross margin. And then third, China. I feel like that's pretty self-explanatory. There's a lot of exportation restrictions. You might be thinking like, oh, well, you said earlier this is a Dutch company. What does this have to do with US restrictions? A lot of ASML's machines are supplied with US products, so they are subject to some restrictions. And then lastly, massive R&D requirements. I can see this as both kind of like a double-edged sword. It could be a bear factor, but it could also be a bull factor. Bull factor in the case that, the economic moat that ASML sits on, it takes a lot for a company to try to replicate what they have done. But the bear factor is obviously just kind of that cash flow crunch, especially when certain quarters have more of a downturn. So,
real quick.
yeah.
To build on one of the bull factors for the AI infrastructure, we kind of touched over Stargate. I'll just go a little into it real quick. Stargate is big for ASML while they're not involved in it directly. It is a project that is 500 billion, and Nvidia is like one of the main players in it, and so are some of these other companies and who they're supplying to Nvidia. So that goes back to ASML. So their machines and processes are going to be important early on to getting this infrastructure going where they want to do it. So that's kind of where they come into play with Stargate, even though they're not directly listed on like the project for the companies that are going to work on it.
Yeah, wait, can you go back real quick?
Yep.
That's a great point. Like I said earlier, with the research and development, double-edged sword. I can also see the same case for China. This might reduce their total addressable market in the short term, right? Cutting off that revenue source from China might be substantial in the short term, but when you look at long term and kind of seeing what countries are doing, like the United States, which is kind of focusing on in-house chip manufacturing, this might increase their total addressable market in the long term as more countries kind of take on projects similar.
Awesome. Next, after this, it's really the more broad overview of the industry. How is it going to look? What, again, factors should we consider to be good? What can be bad? And so this is also a very important part of the presentation. And there's some examples, but yeah, let's transition.
Okay, so going on to the industry outlook, kind of the broader semiconductor industry, not necessarily tailored toward manufacturing equipment, but the first one being Moore's Law. This kind of applies to all technology. But Moore's Law states that transistors on chips double every 2 years, and this increases the demand for products like ASML supplies, which is the manufacturing equipment used to make these chips more efficient. So Moore's Law is the idea computer chips will get twice as powerful about every 2 years because we keep on finding ways to fit more tiny transistors onto them. This is great for the semiconductor industry because it means people always need new, faster, more advanced chips for AI, gaming. We see electric cars, they require more chips. And this kind of keeps big chip companies like ASML in business and keeps pushing technology forward. And then going on to the second one, massive investments in data center for cloud services. I already spoke a lot about this. A lot of the industry outlook are the bull factors for ASML, but kind of one thing to kind of mention on the massive investments in these infrastructure is that it kind of reminds me something of like the space race or the nuclear race, where governments, countries are pooling a lot of money to be dominant leaders in technological advancements. So that's something to consider as well when you look at the scope of it. And then third, electronic vehicles use more advanced chips than traditional gas-powered vehicles. This is just an example of kind of a more technological future. I mean, we see even like refrigerators are smart refrigerators, which, you know, I never thought was going to be the case a couple years ago, but that kind of just like shows the future demand for more chips. And then lastly, government incentives and subsidies for in-house chip manufacturing. I did mention the Stargate example earlier, but this kind of just, these incentives lower the cost for building these chips, makes it easier for companies like TSMC, Samsung, Intel to expand production. And when they do so, they do use the equipment that ASML does make. So that's something to consider.
Next, they did put it earlier, but normally this is where you would put the trading comparables analysis, which real quick, what it is it's effectively comparing your company to its competitors or industry peers to come up with a valuation. And so I have a video explaining this a little bit more in depth that I recently put on the Investment Club YouTube, which I'll send out the link to after this meeting. But the idea is, you know, you want to find similar companies by, you know, industry, region, if that matters, if that's relevant, you know, similar, yeah, like industry, so market, same size, roughly, maturity, as well as ideally growth. So those are some factors to consider. But yeah, I mean, that's normally where you put the comps in this case is not super relevant.
You're good. Okay. This is our own edition just because they did do earnings this morning before market open. The top photo is the Barron's headline. ASML stock erases DeepSeek sell-off, why the CEO thinks cheap AI is a blessing. And basically the CEO this morning said that consistent with our view of the last quarter, the growth in artificial intelligence is the key driver in growth for our industry, which really just touches on everything we've kind of been saying about how for them, the AI boom is going to require them to kind of get that started with their processing and their machines. And then the bottom one just talks about kind of their earnings. It's in euros, unfortunately, but pretty much a one-to-one conversion about. They're reported for the fourth quarter, 685 earnings a share, and it was projected at 672. And then their rep sales on 9.3 billion. So their sales also were about 200 million more in euros than expected. So they had a pretty good fourth quarter, and that projected growth is still expected to come. They do their own, like JP mentioned, they put their own stuff out there, and that's what they expect to keep growing at a constant rate of sorts, if not more.
Yeah, just something to add to the earnings call. We see like the revenue and those earnings beat, but what is also something like really important to consider for the company is their net bookings, which they do release in their presentation. But this quarter they projected or they expected 3.5 billion or 3.5 billion dollars worth of backlog orders. And they beat that expectation by 100%, so double what was expected. So that is something to consider when projecting the future revenue of this company.
Oh yeah, one thing to mention, I mean, they're up 4.4% based off those earnings. I mean, based off that earnings call, which is impressive considering what's going on with DeepSeek and everything in tech being lower. This is another valuation method that works in some cases. It's more applicable for financial institutions, but if you want to find a way around, you know, using the DCF or comps as much, you can rely on the dividend discount model. And that's a YouTube video there. It's also in the modeling tutorial that I sent out, and pretty straightforward way. So just something to keep in mind. Good. The next few slides are really just about the DCF, which again, there's now a video up on the YouTube. That was a fun project last night. But what you do is you project out your income statement, okay, this is a little bit out of order, but your income statement, balance sheet, statement of cash flows, and ultimately come up with a valuation of the company based off of its expected future cash flows. And so with that being said, they did their own DCF. I'll let them get to it.
Okay, so this is the income statement. Lots of projections, which are in the upper left-hand corner. If you're the right-hand corner for you guys, sorry. One of the weird things about them that JP mentioned is it's a lot of backlog orders, especially with how expensive and how hard it is to create this technology. So if you look at a lot of these things, like you look at growth on sales, it like goes up and down, and it really has to do with like backlog orders and things like that. So a lot of these projections that you see up here in this corner, a lot of what we did was we took the last 4 years and took an average of that and just adjusted it to that average, which is what most of this here does. Nothing that really stands out. We see sales continuing to grow at a pretty rapid rate, and we think this is a pretty tame like valuation for them that we did on the DCF. We kept it pretty low end. We could have been a lot more aggressive with it. So yeah, that kind of covers the income statement. Yeah, go ahead.
You go back the
Yep.
slide. Yeah, so income statement, super overwhelming. There's a lot of line items, but just a couple ones I want to point out real quick is the revenue growth. When looking at their compounded annual growth rate for the past 10 years, it's around 15% growth. And that is really impressive. That is high growth. That's comparable to the big tech firms like the Googles, the Microsofts, even the Amazons. So that's really impressive, something to look out for. Also, the EBITDA growth is around 20% compounded annual growth rate when looking at the past 10 years. And this kind of just shows that they're being more efficient in what they do. They're increasing their margins. And this could be from streamlining operations. Got it. Or it comes from them selling a more favorable product mix, like I mentioned earlier.
So balance sheet, pretty much the same thing, just with the way they work and stuff like that. It really, a lot of these adjustments we made just have to do with how weird these percentages can be. Um, Especially for their inventories on percent of sales, increase that by 6%, which might seem like a lot, but if you look at some years, like if you go back to 2014, that's about where they were. And they might end up having a lot more inventory here soon because of the AI boom and having stuff on hand ready to, get going when there are purchases made. So we wanted to bring that kind of back to a higher percentage. And then accounts payable percent of COGS, just bringing it back to where it is now. The average was a little bit lower, and yeah, it was back at 17%, but it could easily fall back to those 2020 to 2022 numbers. So that was just kind of the adjustments. It was really some wonky numbers in all these different things for them, just based on the way they operate.
Just real quick on the balance sheet, super overwhelming. But a couple things to look at is the cash position of the company. If you look at it, it's consistently larger than the long-term debt, total long-term debt of the company. And this kind of gives a company that is subject to the cyclical nature of the semiconductor industry a little bit of flexibility when it comes to their cash position, which is needed to fuel their future investments, especially as much money as they're pulling into research and development. This is really important for a company. It kind of increases their economic moat, like I mentioned earlier, makes it really hard for competitors to compete when they have a kind of a little bit of buffer zone with the cash position that they have.
Yep. Okay. And then last one, statement of cash flows. Just one adjustment here, capital expenditure percent of sales. I think this is one of the more important ones because their capital expenditures are highly increasing and they're going to continue to increase as they spend more money on, stuff like that they're trying to make and stuff like that, and putting together more investments into their technology and machines and really trying to increase their ways of, the research they're doing. So we adjusted it to a more to kind of continue the growth. Like it's at 7.97 here. So this average is a little low in our opinion. We see that continuing to grow year in, year out. So somewhere around the 8.5 brings it up about 0.6% from last year, which we think is a pretty fair kind of adjustment for the statement of cash flows.
One thing I just want to point out real quick is their change in capital stock. So ASML is known to have purchased in the past large amounts of shares repurchased. This is really important when you look at the per share metrics. This is something that increases the return on equity for investors. So I just wanted to point that out.
Okay. Last but not least, the valuation. So the WACC just comes off the internet. Same with the perpetuity growth method, the growth rate, that's also just kind of an average for them in the industry. And then this industry EV/EBITDA multiple, there is really no industry to grab it from. So we just took their average, which was 27%. Looking at where that puts us valuation wise, for the perpetuity, it's 1,050, which is probably a pretty solid valuation on its own. The multiple is a little high at 1,200, almost 1,300. So I think the average is a good number to look at the 1175, which is 70%. It's a little lower because the stock pricing here would have been the 680 that we mentioned before. So it's at around the low 700s today. But yeah, nothing crazy to point out here. That's where we got based on the different multiples and stuff like that.
And that's, yeah, I mean, that's it. Normally, this is where we open it up to questions. We're gonna do questions, but it's gonna be a speed round. We do have sector reports, and I do want to just make sure we can get through those too. So anyone have real quick questions for them regarding the pitch, regarding anything? I can start off real fast. You guys mentioned that they have 90% market share. Do you know what that other, I guess, 10% is really composed of, or who their, I guess, like competitors would be for that?
Competitors wise, no. Only because looking at the comps, it's so hard to figure out who's really directly competing with them with their machinery. So I couldn't give you who it is they're competing with. And I think it would be him that would know the other 10%.
Just kind of something that I mentioned earlier with ASML, they do two different really types of machines. The deep UV ones, and those are for like lower processing capabilities. So I'm assuming that 10% is coming from other manufacturers that are doing that kind of level of manufacturing equipment, not the advanced EUV systems, because I don't think they have any competitors when it comes to that kind of equipment.
Awesome. I guess my biggest question is, how do you expect this company to grow 23% in sales year over year for the next 5 years, especially with the new China AI and less demand in the video structure? Because if anything, I would have bumped the sales numbers down.
That's a great question. When I look at the whole DeepSeek thing and how, what was the law that you mentioned, the Jevons law?
Jevons law, yeah.
Jevons law, where just because something is becoming cheaper doesn't mean it will be less expensive in aggregate. So the commoditization of AI is going to be a huge growth factor for different sectors of businesses that might not have been, in the option of investing in AI. It becomes a lot cheaper, becomes commoditized, it becomes, something scalable. So I guess that's something to kind of consider.
Yeah, I'll touch on two things. One, just looking at the numbers themselves, Leif, and this is right, this is probably a fair point, is if you look at 2022 and then 2023, like just the change in that percentage, it's weird because of the backlog orders and stuff they get. So I think it's hard to like really have a 5 year projection because it's probably going to have the same tendency to like fall on and off of like a high percentage, low percentage. But also they're in a unique position with DeepSeek because they're not actually supplying, like they're supplying two companies that are also supplying out. So Nvidia is supplying out to like Microsoft and Intel. So like for them, their revenue isn't going to go away because the companies they're supplying to, TSM is going to continue to, or not, yeah, TSM's can continue to supply to. And those are the firms that are on some of these big projects that we're seeing in the homeland. And those aren't going to go away because of other countries and companies and stuff. Like the government is not financially involved, but they're heavily involved in promoting this project. So I think that's where that sales growth for them continues, is they're going to be kind of that starting point for those projects going forward.
Yeah, kind of another thing to mention about the scalability. If you consider this manufacturing equipment like fixed costs, this is an opportunity for companies to invest in the fixed costs and the massive corporations like Microsoft, where they can scale these capabilities massively. This might increase the other companies' return on their investments. So it's scalable. Like I said earlier, with the pricing power that this demand for AI chips kind of allows a company like ASML to reap the benefits from. And then, yeah, I think that's it.
One quick thing I will mention, I'm not like advocating or anything. I'm just mentioning from an accounting standpoint, they do have a high backlog of orders. They haven't recognized that revenue yet. So in theory, that could also be another thing that leads to more revenue.
Yeah.
Yeah.
Anyone else? Yeah, go ahead.
One quick thing as well. I think that what's interesting is that all these like magnificent seven corporations are like kind of absorbing capital expenditures on like AI development, and that is effectively ASML's income.
There, yep.
So
Yep.
that increases ASML's income because they and market share increase.
Yeah. Absolutely. Any last quick questions? All right. That being said, thank you guys so much. Yeah, round of applause.